Hello, everyone. How are you? Here we are for episode 3 of the Velez and Sons podcast. We're here during a little bit of a rainier day. I'm your host, Thomas Velez. We got JC in the building.
Good to be here. Man? I'm happy to be here. Happy to record episode number 3
all right.
of our podcast and get this thing going. So what do we have on the menu today?
So today we'll be talking about the current state of how everything is globally, and we'll also be giving a little bit more in-depth examples on first-time home buyers and people that are qualifying for different loans, and what can we do to, give them an example for something that hits closer to home to them.
Some scenarios for the audience. Sounds great. So to open things up, since we last recorded 2 weeks ago, Russia decided to invade Ukraine.
Yeah.
And as we were talking about before the show, we don't want to get too geopolitical for the audience, but we will discuss how all the developments in Europe are going to affect us as Americans. Mm-hmm. We're also going to discuss the continuing inflation crisis here in the U.S. I mean, you can see it at the pump. I'm looking at over $5 almost everywhere I go, which is crazy. I don't remember the last time I seen $5 gas prices. And we'll get into the scenarios as well.
It's funny, I actually filled up at over $5.50 the other day in Yorba Linda. So you can imagine, those prices in downtown LA, the huge cities.
So as our de facto real estate expert, do you think these same crazy inflation hikes that we're seeing with gas prices, with grocery, with ordinary staples, is that reflected in the market, or do you think house prices are starting to level off?
No, well, I think it definitely 100% affects the real estate market just as well as everything else. Right now, we're seeing a huge shift in terms of interest rates are starting to increase again, as you know. But what you're still seeing is really low inventory. So obviously with the global burdens and a lot of uncertainty to where, I don't know if we're going to get into a war or not, who knows the current state of what the world is going to go through, it's going to greatly affect prices in the U.S. and obviously here in SoCal.
Now, something we have to discuss. So we have the situation in Europe, and I don't think anybody wants to get too involved to avoid a escalating conflict that's going to turn into a World War III.
Of course.
But I don't know if you've noticed, but at least here in California, all mask requirements for indoor have been loosened. The NFL,
at least in Orange County,
actually ended all of their COVID-19 related protocols. So it looks like the masks are finally off. You could say that we're maybe at the end of the tunnel of the COVID crisis, but unfortunately now we have this other geopolitical crisis in Europe. Now, you said low inventory. Now, we had discussed, I think, on episode 1 that low inventory was due to seller hesitance. Because they didn't know how COVID was going to affect them. They were reluctant to let go and maybe sell the property. So now that maybe we're out of the woods as far as COVID is concerned, are people going to be more, I guess, encouraged to sell? If prices are still at peak levels, is that going to, have people thinking maybe I should cash in right now and maybe move somewhere else? Where do you stand on that?
I think, sadly to say, because we speak honestly on this podcast, we're just shifting one issue into another. So the same way we said COVID was giving a lot of buyers hesitancy to see what's next, where are we going to go? We can't say that we're completely out of the woods with COVID just yet. As we saw, who knows if there's going to be another variant or everything. In Orange County loosened things up. LA still, they still mask up everywhere they go. I think with the ongoing situation that's extremely fluid and changing every day in terms of the stuff going on in Ukraine, apart with the low inventory, it's the fact that there's going to be an adjustment coming. Only time will tell when that is actually going to happen. But obviously, these ridiculously low interest rates, they weren't going to be around forever, as you know.
Well, we've already seen them going up.
Of course.
And there was an Economist article about how one specific economist was urging the Feds to continue the rate hikes because the inflation crisis is getting out of hand. Now, an example that hits close to home, for example, here in Orange County, I was looking at the apartment complex where my wife and I first moved in about 2.5 years ago, almost 3 years ago, and a 1-bedroom, 1-bath, 700 square foot apartment in June of 2019 was going for $1,650 a month.
Which is still kind of high.
Not too bad, but it's Orange County. It's expensive.
Albeit.
That same apartment, and keep in mind, this is an apartment with no central AC, with no in-unit washer and dryers, no crazy special amenities, is now going for $22.50 a month. So we're talking in less than 3 years, that rent increased $600 a month. Now I know that people's wages are not being increased to meet this inflation.
Oh, of course not.
So in the article, the author was urging the feds to not halt any of the rate increases because we need it to combat the price of everything.
Yeah.
Gas, rents, you name it. So we're looking at possibly a 50 basis point increase for the month of March. Now, what does that mean? Interest rates will go up about 0.5%. 50 basis points is equal to 0.5%.
To which a lot of people probably don't realize, but 0.5 percentage point is a pretty substantial increase.
It is.
When we're talking about huge numbers from...
You're talking hundreds of dollars a month on your monthlies. Now, if you're coupling high interest rates or rates that are continuing to increase with already historically high real estate prices,
Yeah, it's a bad combination.
It's a pretty rugged market.
So the thing is, too, like I had mentioned, in terms of, there's a lot of speculation on a recession and things of that nature. I think when the word recession gets tossed around, everybody panics. Obviously, for millennials and people that can remember the early 2000s and things of that nature, the recession in 2008, that was the worst one since the Great Depression.
Yep. So
that was a recession actually caused 100% by the real estate and loan market.
Yep.
So we took a negative 17% decrease in the GDP of the country and everything in terms of what goes on, as opposed to recessions that started from the 1980s to the 90s to the one in 2008. Huge difference. So it's not going to be anything close to that level. Obviously, what goes up must come down. So the interest rates, as you said, hopefully they level out again to where this inflation gets cut off, because as you know, it's getting ridiculous. But to shift things a little bit, I want to go ahead and give the viewers some easy examples. So we're going to start off with the conventional loan.
Right.
So just to make everything easier for the viewers at home, we're going to use a house that's worth $500,000.
Right.
So dive in.
So conventional loan, $500,000 purchase price.
Yeah.
So this buyer is going to need a FICO of 660 and above to meet the credit requirement.
Is that super high? Is that, where does that rank in terms of
a 660 FICO is pretty reasonable. You have to keep your credit balances within 15 to 25%.
Okay.
You don't want to be maxing out all of your revolving balances. Ideally, you're not paying a lot of personal loans, or your student loan requirements are pretty tame. Mm-hmm. But 660, it's not I think the average is 680 to 700. So
it's manageable.
So it's very manageable for a buyer.
Okay.
The second thing is we're going the route of a conventional, but this person doesn't have the standard 20% down. They have 3%. So what does that mean for them? That 3%, they're going to have to put down $15,000 plus an estimated $12,000 to $15,000 in prepays. What is a prepay? Interest, insurance, and property taxes.
Okay.
All paid upfront. Okay. And the next thing. So if you combine the prepays, the closing costs, and their down payment, they're looking at having to, out of pocket, come to the table with $27,000 to $30,000 to get that conventional loan and to have a decent, monthly payment.
So, quick question, just for, we're breaking down everything pretty easily for the viewers. Is there any difference in the length of a closing as opposed to if I do like a conventional loan to an FHA, What do time periods typically range at for a standard residential single family?
Time periods are tricky.
Okay.
And they're especially tricky in this market because nowadays you make an offer, it's not the only offer. Mm-hmm. Maybe you're competing with 5 or 10 other offers. So the buyer has their pick. Mm-hmm. You're not the one in charge, essentially. The seller is thinking, well, you know what? I have 10 offers and they're all over asking price. I can just pick the one that's best for me, maybe the one that's most convenient for me, the fastest one. Maybe one of those 10 offers is an all-cash offer.
Okay.
And there's no financing avenue that they have to go through. So that one's going to be the fastest close.
So if you don't go through an all-cash offer, What's a seller's inclination to decipher all the different types of offers? So how do I choose? What if someone's offering the same, but someone says, oh, they offered better terms? What does that mean?
Now, the better terms, that's all contingent on maybe whoever your agent is, and they can advise you what the better terms are. So in this case, this person is coming with a conventional loan. And that conventional loan is sometimes, not all the time, a little easier to navigate than, say, an FHA loan, because there's not as many requirements or restrictions. Now, the financing is where the time length of this can be affected. Now, you have the real estate aspect of a transaction, where you make an offer, where you see the house, counter offer, contingencies, you're going back and forth with the seller.
Request for repairs.
But of course, you have the financing aspect. How are you going to afford this house? You have your lender, your mortgage broker, your loan officer, and they have to qualify you and you have to meet the terms. Okay. So in this case, this guy has to meet the terms of a conventional loan because he didn't have 20% down. He has 3%. He has to pay that 17% difference with private mortgage insurance. Okay. So that's going to make his monthly payment a little higher.
Something we already kind of touched base about, right? That PMI that people get confused about.
Right. So the PMI is not just restricted to FHA loans. You can have PMI with a conventional if you're coming with less than 20% down, just to meet that difference. You know, and until you get to 20% equity, then your PMI is removed.
So let's move on, and we're going to go on to example B. So a little bit, they already talked about the FHA loan. Right. You know, it's, I think depending on the county or where you are geographically, it'll be used more or less. So what we're going to do with an FHA loan, it's going to be a little bit different than the conventional. Right. So your FICO is going to range anywhere from like 580. It could go all the way up to like 630.
Now, a 580, that's a substantially subpar FICO score. Yeah. A lot of these people have really high credit balances. They may have some delinquencies on their credit report, some late payments, some collections. Yeah. So 580 is definitely lower tier. So, but that doesn't rule you out of being able to buy a home. You can still explore the FHA route.
And with that one, it's going to be a little bit different in terms of instead of a 3%, it's going to go all the way up, not very much, but to a 3.5. Right. So that difference, instead of $15,000 payment, it's going to move up to a $17,000.
Now, just to be clear, we're sticking with that $500,000 purchase point.
Correct. So instead of that $15,000, it'll go up to $17,500, and we'll need 12 to 15 for that same closing costs and prepays.
Your PMI, your interest, your property taxes.
So we're going to be looking at anywhere from the ground total that you'll need on off for everything included, from $29,500 all the way up to like $32,500.
Right. Now, before we go on to scenario number 3, on this loan, in our notes, we did discuss the Cal HFA, not FHA, HFA, or Cal, how did you say it?
Cal HAFA. So
Cal HAFA.
With that one, that's going to be, it's going to fall under the umbrella of an FHA loan. Right. So there's going to be some special cases to where some people can't even, they can't bring any money down for a down payment or closing costs. So that is something that under a Cal HAFA loan, which again falls under that umbrella of the FHA loan, you can be able to almost essentially 100% finance the entire thing. But in order to do so, it is a little bit trickier. So you do need some prerequisites. Right. So first, you're going to need a loan requirement, and then adding on to that, you're going to need to take a course on a Cal HAFA loan, and you're going to need to get a certificate by the end of it. That's also approved by your mortgage lender and by the bank in which you're getting the loan.
Now, not every mortgage lender is a Cal HAFA approved lender, correct?
Correct. So they have to be specially approved, and that's also a little bit more time consuming to go through that route. Obviously, you need to be approved, and you got to go through all the intricacies of it. But if you are someone that, you know, you're a little bit more pressed monetary-wise, and you can make it work that way, that's another route people tend to explore.
Now, for anyone wondering, can I use a Cal HAFA loan for an investment property?
No.
Big no.
Big no. And it also has to be your primary residence.
Right.
And all of that stuff is obviously verified by, the banks, all that good stuff that takes place. So you can't use it as an investment property. It has to be your primary residence.
And the most important thing, this has to be for first-time buyers only.
For a first-time
home buyer
only.
Primary residence,
and you have to take the class, you have to get the certificate, your lender has to be approved by it, and they also have to put their stamp of approval on it as well.
So buyers, for those of you that have no money saved, fret not, there are programs here to help you.
That cater towards you and your needs, because we know everybody's super different.
They're a little stricter, but there are options.
Everything is a case-to-case basis, and we'll give you our last one, example number 3, once again with the same purchase price of $500,000. It's going to be the VA loan.
The VA loan, got it.
So what can you tell me about the VA loan?
Now, VA loans are loans designed for any veteran of the armed forces.
Correct.
VA stands for Veterans Administration. Now, the VA loan, kind of like the Fha Loan, is not something that you can just go to any bank and say, yeah, here's my VA loan. Because any loan that you get as a veteran has to be approved by the Veterans Administration.
And with that come also requisites. What are some of those requisites that the VA department requires?
So, number 1, and most importantly, a certificate of eligibility from the VA department. You can't just lie and say, oh yeah, I served in this armed force or in this year. You need your certificate of eligibility. That's step number 1. That gets you through the door with the VA department.
So to get that certificate of eligibility, you're going to need at least 181 days of service.
Which is about 6 months.
And that's during peacetime, or 90 days of service during wartime, or 6 years of credible service in the reserves or National Guard.
So if the U.S. government was to openly declare war in Russia, and you serve for about 3 months,
when I come back,
you qualify.
I qualify for that VA loan. And then the last one is also if you are the surviving spouse of someone that passed away.
Of any service member.
Of any service member, that also falls in the umbrella of everything that we had just said.
Okay.
So if they were acting with the 90 days during wartime, if they were doing the 181 days during peacetime, if they did the service in the reserves or National Guard, so if they meet all those requirements and there's the surviving spouse, can also qualify for the benefits.
Now, to know, depending on the circumstance, now there's a lot of different VA circumstances out there. Any VA buyer, if they have the right set of I don't want to use the word circumstances again, but it is, they can receive down payment and closing cost assistance.
Okay.
So if they say, hey, you know what, I don't have any money saved up, I need help with the down payment, I don't have anything to cover closing costs, there are options for those VA buyers as well.
So the good thing is, we touch base on a couple of different scenarios. Obviously, there's a lot of different loans. We could talk about the jumbo loan, commercial loans and everything, but we're going to talk about the ones that are closest to home in terms of what everyday people, most typically everything that we deal with, they usually go through these types of loans. So in summary, we have conventional, which is a little bit better FICO score. You put a little bit less down. We have FHA, which I think more people fit under that umbrella, and then the umbrella of the CalHFA under the FHA, and then the VA loan, which is the last one, which we know there's a lot of active service members in the Army, Navy, Air Force, all that good stuff. We appreciate their service, so it's a good thing the government does a good job in taking care of them as well.
Exactly. So as far as next week's podcast, we'll discuss a little more of those not so common loans, like you said, the non-conforming loans or the jumbo loans. But these 3 are probably what you see the most. And even in more expensive areas like your Belinda or Irvine, where house prices are commonly seen over $1 million, most of those home buyers got into the market when those were $600,000, $700,000 homes, and we're still under the jumbo loan requirements. Nowadays they have some equity, so if they refi, they would still fall under the conforming loan requirements, and it would be a conventional refinance. So next week we'll discuss those other loans as well, and we'll see what's going to be happening in Russia, in Ukraine. Hopefully this crisis doesn't keep escalating. We'll talk about inflation again, state of the market. We'll give buyers a little local market analysis just to see where home prices are now, maybe compared to where they were 6 months ago.
You know, as always, it's been a pleasure doing this podcast with you. Obviously, this is something we're new to as well. So, you know, we'll be growing along with you guys, the viewers, seeing our journey, you know, hopefully get better and bigger as we go along. Our job is to always keep the viewers informed, keep everybody up to date on, you know, everything real estate. Obviously, real estate's a very intimidating market. So whatever we can do to ease you in and make you feel safe and comfortable around this, you know, really complex industry. You know, as always, I had a great time, and I hope you guys enjoyed. This is Thomas Velez, JC.
Yes, and before we exit, I just want to keep in mind to the viewers, we will have these podcasts in both English and Spanish on our website, and we'll have clips on our Instagram, Facebook, YouTube, social media platforms. So viewers, if you have any questions for us, or if they have any topics they would like for us to discuss, feel free to leave a comment. We'd love to hear from you guys. And once again, always a pleasure.
Thank you, man.
And we'll see you guys next time.
Thank you.